Hello and welcome to this video on price-to-earnings ratio or PER. If you're a beginner to investing or just looking to refresh your knowledge on stock market fundamentals, you've come to the right place. In this video, we'll be discussing what PER is, how to calculate it, and why it's important for investors. What is PER? The price-to-earnings ratio, also known as the PE ratio, is a financial metric that measures a company's current stock price relative to its earnings per share EPS. In simpler terms, it tells us how much investors are willing to pay for each dollar of a company's earnings. For example, a company with a PER of 20 means that investors are willing to pay $20 for every $1 of earnings generated by that company. How to calculate PER? Calculating the PER is fairly straightforward. To find the PER, you simply divide the current market price per share of a company's stock by its EPS. For example, if a company has a stock price of $50 per share and an EPS of $2, its PER would be 25. Per stock price EPS. Why is PER important? PER is an important metric for investors as it helps them evaluate whether a company's stock is overvalued or undervalued. A high PER may indicate that a stock is overpriced relative to its earnings, while a low PER may indicate that a stock is undervalued. However, it's important to note that PER should not be the only factor considered when evaluating a company's stock. It's also important to consider other financial metrics, such as revenue growth, profit margins, and debt-to-equity ratios, among others. Limitations of PER. While PER is a useful metric, it has some limitations that investors should be aware of. First, it doesn't take into account a company's growth prospects or potential future earnings. A company with a high PER may be overvalued if its future growth prospects don't justify its current stock price. Similarly, a company with a low PER may be undervalued if it has strong growth potential. Second, the PER can vary significantly across industries. For example, technology companies often have higher PERs than companies in more mature industries, such as utilities or consumer goods. Therefore, it's important to compare a company's PER with those of its peers within the same industry. Conclusion. In conclusion, PER is a useful financial metric that helps investors evaluate whether a company's stock is overvalued or undervalued. While it's an important factor to consider, it should not be the only metric used to evaluate a company's stock. Other financial metrics, as well as a company's growth prospects and potential future earnings, should also be taken into account. Thank you for watching, and happy investing.